You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
And welcome to Vol Views. I am your guest host, Mark Sebastian. Mark Longo is on assignment. I assigned him to head to for the Austin conference for the OIC, and he'll be back next week. Don't worry. Joining me is my good friend and brilliant trader and all-around smart guy, Jared Woodard. Welcome, Jared.
Mark, I'm so happy to be here.
Yeah. How have you been? Anything exciting going on?
Quite a lot. Not everything that I can tell you yet, but I haven't been dawdling, that's for sure.
Well, that's great to hear. That's super exciting. So let's start out with our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
And here we are, our volatility review. Here's where we're going to talk about what's been going on. And Jared, what do you see about what's been going on lately in the world of vol?
This is one of those environments where I feel like nobody's happy. Guys who've been looking for a pickup in volatility, not just in equities, but in rates, maybe even in commodities, haven't really had much joy yet this year. But at the same time, if you look at the term structure in equity vol or in VIX, it's steep enough that there's no obvious sales, at least none of the typical stuff that worked last year. So it feels like a lot of people have been stepping back, not for any strong reasons, but for lack of opportunities, I think.
Yeah, it's interesting. If the most crowded trade of the year was the VIX yield trade last year, the most uncrowded trade of the year this year might currently be the yield play. It hasn't worked very well, and a lot of guys are just getting their lunch handed to them, trying to play a short vol position to collect yield because you're not making any money doing it.
Right, and there's I think some more room for nuance that's still maybe hasn't been squeezed out of the market yet. We talked about this on the show before, I think a few times in the last several months, but the maturity that you play at rather than just being outright long or short vol, I think is getting more attention, and then definitely looking at the timing of changes in the economy. We got that jobs report today where the headline number was a real big beat, but wages hadn't really moved, and I think that's a typical. It really encapsulates this kind of environment where the news is okay, but not good enough to really push anyone heavily in one direction.
No, you're absolutely right, and that's really been the problem. And although one thing I would say is when you look, it does not look, for lack of volatility, there was, still plenty of volume in VIX options last month. While April was not as good as April 2013 and was less than March of 2014, it still saw 178,167 contracts trade. VIX futures volume in April was just under 3.75 million contracts. Year to date, VIX futures volume is 16.12 million contracts, and average daily volume of almost 200,000 contracts per day, way ahead of 2013. So it's interesting that while vol itself has been low, there's so much VIX activity this year.
Yeah, it's amazing to think how far we've come, thinking through some of those numbers you just cited. If you go back 3 or 4 years ago and told people that they could expect that kind of volume in VIX futures, who would have believed you? And our expectations, I guess, adjust so quickly that the lack of new record highs in those volumes is seen as kind of disappointing. But in fact, that's a really huge market.
Yep, for sure.
So, the other, moving away from VIX stuff, this was an interesting kind of a quarter, and then into April as well. The divergence we saw in the big indexes,
the
sell-off in tech, and then the small caps kind of got on board there too. How did you kind of treat that divergence in those indexes? Were you playing that trade at all?
Yeah, we were actually, Swan, we moved more like an aircraft carrier than a destroyer, but we were definitely watching that, and that was one of the things that we were really pushing at in terms of one of the main reasons why we were not kind of pulling off the hedge. We thought hedging was so important. The Russell just had a terrible quarter. So did the Nasdaq. They both got just absolutely obliterated. That the S&P is basically up on the year, and the Dow, with what's happened in the other two indexes, has been phenomenal. And look at the spread now between RVX and VXN and the VIX. I mean, there's just so much more perceived risk in the momentum stocks than there is in big industrial right now.
Yeah, it is pretty interesting that we've got VIX closing, just a little bit under 13 at the end of this week on May 2nd, while RVX is still above 20.
Yeah.
And that big divergence persists, even though the markets have quieted down. You're right. That's persisting, and so I've had some stuff on, and I've talked to a couple other people with some relative value trades on, who are getting a little bit impatient, I think, for things to start moving together.
Yeah, it's so tempting to do like a strangle swap or something like that, but it would not have worked very well today. The piece that we've done, and I kind of like, is that some of these, with more vol in these indexes and them near all-time highs, they're like begging you to put on a front spread.
Yeah, totally.
Yeah, so that's been the other piece, and we have done a couple of those at Swan Advisors in the last Swan Wealth Advisors in the last couple of weeks. So other kind of points so we've kind of hit. Have you watched VXST at all?
Yeah, I've watched it. I haven't really done much in the way of trading there yet, but I guess it's the same kind of stance as before. A lot of people are waiting to see if some volume develops, but it's definitely an interesting idea. What about you?
Yeah, I mean, it's one I watch. Unlike some of the other indexes, this does typically get some volume every day. The markets are a little annoyingly wide, but if an open outcry broker can get something done. We've been, I was talking to one of the SIBO research guys today, and they were telling me that, we're getting somebody coming in, on a weekly or semi-weekly basis, trying to trade between, a few hundred up to a few thousand contracts. Unfortunately, it's all when this stuff is really cheap, like right now.
That's interesting.
That's been the big thing we've seen. We talked a little the RVX, the Russell. I mean, that's been a neat little product. But and if I'll tell you, if the only thing you're looking at, and I'm sure you agree with me on this one, Jared, because we've already have kind of partially talked about this. But if you're only looking at the VIX, you are really missing out on how volatile the market it currently is.
Absolutely. I think it's an under the radar kind of year, but you're right that there's been plenty of stuff moving and plenty of stuff to do. It's just that it's not in an obvious way.
Yeah, it's not the S&P 500, it's the Russell. It's the Russell 2000. One of the things that I've got on my I am watching like a hawk every day is how's the RVX VIX spread? How's the VXN VIX spread? One of the interesting things though is that we kind of talked about this a couple times, is that while VXN and VIX are out of whack and RVX and VIX are out of whack, RVX and VXN are right in line. So there's not a lot of relative, there's not an edge between those two. So that's where the risk is. You can see where the risk is. So we've got some for a discussion topic, Mark. Mark likes to drum up controversy. I don't know if you knew that. It's besides having the corner of the market in goatees, mock turtlenecks, and baritone voices, he's also cornered the market in pulling controversy out. So
yeah.
So Bloomberg's Mark Gilbert wrote an opinion that stock, bond, and currency volatility are disappearing, and that using the VIX, the move, and U.S. Treasury bond volatility is at its lowest level in 5 years. The Deutsche's currency volatility index is really low. He's wondering, where did all the volatility go? What is it? What's causing this price stability to come in? And is volatility artificially suppressed? And is there going to be some sort of risk backfire on some of the central banks start to unwind some of this?
Yeah. Well, so we just that kind of.
This is I'll tell you, everything he wrote, that's your department, not mine.
Well, look, okay. So let me take. First of all, our instinct might be to be contrarian on this kind of article, because we've just been talking about places where there's meaningful volatility. Just the first point. Second point, that article mentioned, average VIX levels a few different years, this year, last year, and how it's down significantly from 2011, 12, 2009. But the long run, we know average levels for VIX can be much lower, and so seeing the S&P vol around in the low teens, to me, isn't by itself all that significant, especially not at this point in an economic cycle. And at the same token, I think that this view is right, and we've seen this proven in bank earnings in a big way. You've seen big cuts in fixed income, currency, and commodity departments, really for a few years now, as the volatility in these markets, not just in the sense of option implied vol indexes, but movement in the markets really has been low, and that's true in currencies. It's true in commodities. There was two interesting news items today that came out that I think really highlight this trend. First was that Macquarie, the Australian bank, has been doing incredibly well over the last year. Most of the revenue comes now from the Americas rather than from Australia. And what really got everyone's attention was the fact that the story that they've been doing especially well, what's really been driving part of their earnings, has actually been their fixed income, currency, commodity trading. Even though volatility is low, they've been able to make it work. I think some of those are through special financing deals rather than just outright kind of guys on trading desks. But nevertheless, there's room to grow, I think, as some of the bigger banks have pulled back their operations. It seems like some of these mid-level and smaller outfits are stepping in to fill the gap. Second data point that kind of is the other side, I saw JP Morgan kind of came out late today after the close with its 10Q for the first quarter, warning that fixed income and equity revenue all in markets revenue could be down 20% for the second quarter, citing a challenging environment. So, I think there is a lot of room for the argument that overall market volatility has been low. That's been hurting banks. It's been creating opportunity for others. As far as individuals, I think it's been a kind of a gamma year, maybe more than a vega year, I guess is how I would summarize it.
Yeah, you're right. There have been moments. I mean, and we've got this 12 handle now on the VIX right now, but it's been weird. It's been part of the reason why, even though market volatility has been low, is there has been chances to make money owning gamma and managing gamma, because it's not been expensive to hold and own for the most part generally. And if you can wait a little bit, and you're willing to let your gamma run a little bit, you can get a really good move out of the market. So maybe volatility is low, but momentum is high. Maybe that's the way that I would think about it.
Yeah, and I think there's also been good opportunities on the short side of gamma as well that don't require a big bet about change in the level of implied vol, but just passage of time. You can get paid, and the moves haven't been so severe this year that being short gamma, especially out in the wings in some of the big indexes, has worked really well.
Yep. So yeah, I mean that's a kind of a cool thing. All right, now there is a new volatility index fund centered in Australia, the Grant Samuel Funds, and 333 will launch the 333 Volatility Advantage Fund. This will give retail investors exposure to options on the VIX index. The fund will launch with a minimum investment of $25,000. The 333 fund allows investors to access VIX index through options and volatility. It will offer daily liquidity and limits loss to 5% in a VIX expiry. So it looks like this is kind of a long. It sounds like this is a long VIX play.
Yeah, I'm not sure. I've spoken with one of the guys involved before. I think the guy at 333, who had done some smart work. I was reading, and so it seems like a interesting person. I think it's a positive sign, giving them a little free advertising, I guess. But it's a positive sign to see investors in other countries getting keyed into volatility products and kind of plugged into these markets. So, whatever the merits of that particular offering, I think it is a nice development.
Yeah.
And it kind of dovetails as well into this story about the India VIX that I've seen a couple places we could talk about.
Yeah.
It's a kind of a timely story with the election.
Yeah, that vol in India has been apparently pretty crazy, and they're not getting any demand for what is it, the Nifty 50 VIX, basically. Mm-hmm. And it's on April 22nd, on a day where the S&P India Index hit, I guess it's called the BSE Sensex, reaching say S&P BSE Sensex 15 times and don't say Sensex once.
Right.
I challenge you. I can see my wife walking by and I'm talking about Sensex, and she goes, "What are you doing in there?"
Is Jared tempting you into vice again? Yeah.
Who's doing Sensex? So the S&P BSE Sensex hit 2287, and then the NSE Nifty hit 6861, and there's just really not a lot of volume in those Nifty 50 VIX futures.
Right. Yeah, it is a crazy kind of a lack of volume, I guess we could say, given the size of the selection and how much hinges on it. It's not. I'm not seeing any stories about it in the U.S. media about just the election and the general business media. But it's a big deal. Who was it? Some comedian was talking. Oh, it was not Stephen Colbert. John Oliver, the British guy.
Oh yeah.
Was talking about this. I think that this is a huge election in terms of the number of people voting. Maybe it's the biggest election ever, and it has big implications for policy. But unfortunately, this contract hasn't seen a lot of uptake yet.
No.
But it's still early, and
they're writing some off to margin and some big roll yield problems. Rollover cost was 20% the last 15 to 20% the last four expiries, but But if you'd have gone long the product, you'd be up 140%. You'd have made 140% returns, but have also paid 113% in the long roll yield. So you'd have picked up 27%. That could do it. Well, that's why you don't consistently. You need to be strategically long these products and have some real strategy. I don't know if you've talked too much on the show about your CMTA VIX overlay strategy that you do, but your big key edge that you talk about, and speaking of free plugs, is that your expertise in managing roll risk.
Yeah, well, I appreciate that. It's not too much of a secret sauce, really, because if you keep your exposure low and then scale in when you need it, you can absolutely minimize those costs. I think that from the standpoint of these new products, I think there's probably some room for more investor education. I mean, the exchanges are doing a great job. Russell Rhodes at the CBOE and a lot of other educators are doing really good work. I think that maybe launching some exchange traded products or working with others to launch those that can minimize those roll costs might get more investors interested. But each market's a little bit different. So the fact that that there's people going into China, the fact that these things have launched in India, again, it's one of those things that I think 5 years ago people would have been really unlikely to believe that this kind of expansion was going to work as well as it has so far. So definitely something to watch.
Agreed. So absolutely, I agree. So there's I'm trying to see what else. So those are all the big stories that Mark put in. The other thing you want to talk about was, and I like this, some of the metals. Mm-hmm. The first one is metals and ag. So spring wheat is showing volatility. I'm not that big into the grains, but there's a lot of there are a lot of guys trading the spread and doing pretty well, doing different things within the spread, and March highs and lows have been pretty aggressive. So there's no VIX wheat index, or there's no volatility wheat index that I'm super aware of. I think there's one big conglomerate ag index, but apparently, if you think about the weather, there is some good reasons for some volatility there.
Yeah, I think I read somewhere that there was a specialized wheat contract that they actually canceled a launch of because of the situation in Ukraine. So I don't know if that might be a contributing factor.
Yeah.
I don't trade ags as much myself either, despite being a commodity trading advisor. That's just a commodity I don't have any expertise in. But the metals, I think, are a little bit maybe more familiar. And
yes,
that's the position limits question there keeps coming up every year or two, it seems.
Yeah. So on CME, it said it's considering introduction of daily price limits on gold and silver due to volatility. The CME Group Director of Metal Products at the panel discussion at the industry event would have price limits in gold and silver. That's something that we are looking into. I wonder about that. I mean, if you think that the GVZs are around 1485, they drop daily price limits in there. The question is, do you think daily price limits help volatility, or do you think do they really help control volatility, or do you think they are they really that would it make a big difference, you think, in gold and silver?
Well, I'm inclined to say no, but then you think back to what that period last year where you had that huge sell-off in gold, and as in that kind of situation, it seems like some limits make a bit of sense.
Yeah. Well, I think the smartest thing they did remember when silver went all crazy, and then they came in and said, "Oh, you can't just trade silver for free anymore," and then it actually kind of found a level that it belonged at. That I think messing with margin requirements makes a lot more sense to me than messing with daily limits. Changing a product that's traded that one way for 30 some odd years, right?
I agree totally. I think that if you can get that work done with margin requirements, then leaving the price alone makes a lot more sense.
Yeah. I'm just never in favor of messing with something that's been the way it is for a long time.
I like the idea of publicizing that stuff in advance too. Like if you know that, given certain criteria, margin requirements are going to increase, then you can kind of, I think, suppress undesirable volatility or suppress people from getting maybe too speculative in a kind of a frenzied way in advance.
Right, but that actually would be a great idea, and I would love to see the CME do that.
I remember that when the CFE listed variance swap futures some years ago, I remember they had a schedule that kind of stated out in advance at different variance levels, the margin requirements would increase to this amount. And although it never really it didn't matter for that product ever. That kind of stuck with me as like a really appropriate way to approach a volatility product, where the more volatile, the higher the nominal level of that product is, the more volatile the market in general is, which means it's going to be a great idea to have higher margin requirements I mean, it's kind of pro-cyclical, and that would be a downside to it, but that idea of having some kind of buffers in place in advance, I think would be a much better signal to the markets rather than just a press release coming out of nowhere one day.
Right.
Forces change.
I agree. And, I loved those variance swap futures, and it's too bad that, and it of all the products that the SIBO has come out with, if they could have really gotten that margining stuff figured out right and gotten the clearing firms to understand it, that would have been I think that would have been an unbelievable product to trade. But unfortunately, certain player, I'm not going to get too much into it, but that's variance trades are very profitable for upstairs groups. They didn't have a lot of reason to want to push this product very much.
That makes sense.
So, fixed income. Crazy. Did you see what happened with the 10-year and the 30-year today?
I was watching a little bit. I was kind of watching the shorter term stuff a little bit more these days. But what do you
pull up a daily trading range of the long bond? You will be just if you have you looked at it today yet?
I mean, there was that huge kind of sell off and then snap back higher.
Yeah.
I mean, we're still in that range on a longer time frame, right?
Right. But today was just a crazy vol day. And so we had one of the biggest trading ranges in the 10-year and the 30-year. And, I can't remember the last time I saw a range like that. And certainly percentage-wise, it was a big range. Although everything with the yields at 2.6, everything's a big move. But they came in and they still crushed volatility in the options.
Yeah,
but, just destroyed it again.
I always like skeptical of telling stories too much about this kind of thing, but I wonder how much the difference between the headline jobs number and then the kind of lackluster wage number really whipsawed people.
Yeah. I mean, it really did. I mean, we traded as low as like one in the long bond. We got down to 134.25. Traded as high as 136.15.
When do we get? Here's the question: when do we get? On a longer time
30
frame?
seconds, obviously. No, 25, 30 seconds. Sorry.
When do we get on a longer time frame a big increase, a kind of secular big increase in fixed income volatility?
I think when the next time you see something like that is when the 10-year starts to make a real run at 3% again.
Mm-hmm.
And, if we because we got really close to kind of this, because everybody's using the 10-year to hedge off their risk in, CMOs and asset backs and all these other things. So if you get a quick move in the 10-year and it's not slow and it's a run at, 2.75 or really 3, you could see vol start to move pretty quickly. And if you want to know really where a 10-year vol is, the bond options are nice and the note options, but Really the Eurodollar options are really where kind of the back end of the Eurodollar options are where we're going to see all the vol pick up first.
Sure. I've been, I'm a fixed income newbie relative to a lot of these guys, but I've been trading Eurodollar options a little bit this year, and it's a real interesting market. And there's a lot of some similarities with the VIX curve is what really got me interested. And,
yeah. I mean, it's crazy. You put on these flies that you think you're like, this is a cool fly that I can do for a credit, and yada yada. And you think you're gonna win, and then or you get put it on for free, and it actually is a loser. It's really weird.
Mm-hmm.
So
yeah. But that reminds me, one other thing. It's been so long since we had a chance to talk. I wanted to get your view on some of the market structure issues that have been in the news lately. For Expiring Monthly, you wrote a nice feature. This was a few years ago, I guess now, on some of the features of the structure in the options markets.
Yeah.
And now that stuff is back in the news. I wonder if you have any updated thoughts on that.
On kind of the whole, in terms of how it affects high frequency and things like that. Yeah, I mean, one of the big discussion topics, which shocks me. So Michael Lewis comes out with this Flash Boys thing, and everyone's like, oh, they've got this speed advantage, they've got this advantage. They're getting out in front of customers to pick up, hundreds and hundreds of pennies. They're not trying to make money picking up these hundredths of a penny. That is not why they're trying to flash out front. What they're trying to do is flash out front and then be an offer on a maker-taker exchange, which a lot of the stock markets are. We've talked in the option markets about how, the fact that there's kind of more traditional PFOF and then there's this maker-taker concept. And the stock market is almost exclusively kind of maker-taker. And, but if you game things right and if you structure yourself right, and there are certain areas where it's not, for instance, in some of these dark pools, it's not, you pop in front of the guy, buy the stock in a way where you're not paying for it, and then end up getting a liquidity fee when they go to buy it. That's really where you get how these guys are making their money. If the SEC wants to end, it's funny. You hear these guys talk about, oh, they should do a trader tax. Stupidest thing on the planet. They should put in a speed bumper. Maybe the second dumbest thing. They should end payment for order flow. Would kill 99% of not 99. That's hyperbole, but I'll say 85% of high freak would be gone, and the high frequency left would be the arbitrage play that actually probably should be there.
Mm-hmm.
And so it just drives me nuts that a guy can write 400 pages on high frequency trading and maybe devote 12 words to payment for order flow.
Yeah. And in the coverage following it up, I've seen, I think one occasion on major media where we actually start talking about payment for order flow and market structure instead of just.
And now she doesn't work for that media organization anymore. Too bad.
Is that true?
What? Are you talking about Caitlin at the Wall Street Journal?
Oh, no. I was thinking of on TV. Kelly Evans. That's who it is.
Oh yeah, no, Kelly. That was right. I remember watching that. I was like, "Good job, Kelly. Way to go." And did you see when she was interviewing the New York AG? She asked him about PFOF, and the guy had no clue what she was talking about.
No idea.
Clearly.
No idea. And they actually, this is funny. They posted the interview online later, but they were missing that segment, and I'm sure it was just an accident or an oversight or whatever.
Oh yeah.
I asked her. I said, you missed the best part, and so I think that they actually added it in. I'll have to go online and check that out again and see if they added it in. But that was amazing that she just kind of brought that up, and for all the crap we give some of those people in the financial media, and I don't throw around compliments to them very often. Kelly Evans is really good at her job, and she's probably the lone anchor on CNBC that drives me to CNBC rather than away from CNBC. I think that for the most part, Bloomberg and even Fox is starting to catch up.
and do a better job of actual markets coverage than CNBC. And Kelly really does bring in a top-notch reporting style because she does her homework and doesn't just rely on producer notes.
Mm-hmm.
So,
well, I mean, hopefully we can get more discussion of some of these Reg NMS issues instead of hyperbole, and I wonder, we kind of watching this stuff from the standpoint of options markets for so long. It's been pretty fascinating to see it bubble up, and but yeah, I mean, I think that's a kind of a big topic that's probably going to come back. I can foresee. I mean, I have a prediction that whenever we get a meaningful shift in Fed stance and the economy moving along enough, I can imagine a scenario where you have the confluence of an increase in fixed income volatility, some of these market structure issues coming back, and the fact that so many of these large banks and broker dealers have slashed their fixed income currency commodity departments, meaning fewer people to take the other side of trades, fewer, less institutional memory and depth on the desks. I could imagine a situation where some of these things all come together for not anything recession causing or crazy like that, but a bout of volatility stemming just from these market structure issues all kind of happening at once. I don't know if it'll be this year, but maybe next year.
And the interesting thing is if they went in and actually went after and fixed some of these market structure issues, you would actually see liquidity return spreads have widened. I don't know if people know this, but spreads have widened. If you're doing anything more than like a 1 or a 2 lot in the financial markets, spreads are wider than they were 3 years ago. And if you got rid of a lot of these market structure issues, PFOF, I think you'd see a lot of guys who left the market on the local level in disgust because they were sick of being picked off for PFOF. There's nothing worse than selling something to Citadel at a loss and then having to pay them for that flow. At least not having to pay for the flow might make me feel a little better. I bet you'd see a lot of market participants return, and you'd see a lot of these issues that really concern people and are bad for the overall market kind of leave. And it's just sad that the SEC and this New York AG are unwilling to really address it. So mostly because they don't get it. So, with that, Jared, now that we've basically covered everything there is in volatility, why don't we close out our volatility review and move into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
And welcome to the volatility voicemail. Here's question number 1 is from Allan S. And it says, I hear a lot about gamma scalping on the network, but what about volatility scalping? Isn't that really what you're doing? Aren't most option traders really volatility traders? Thank you for clarifying. Well, you want to hit that or do you want me to do it?
Well, one thing that just stood out to me is maybe in an ideal world, in my ideal world, most options traders are volatility traders, but there's a lot of people use options for the leverage. Let's be honest. That's a big part of speculation in the options market is the fact that you can get that leverage. I don't endorse that or promote that, but I think that's definitely present. And at the same time, I think there's also a lot of traders who aren't using options for leverage or to trade volatility, at least not intentionally. But I'm thinking about asset managers who are a little bit more conservative and might sell a call against their stocks or buy some protective puts or things like of that nature. Even if they're taking a position in volatility, they're not really, that's not the reason for the trade, or not, it's not the primary thing in their minds. But it's a good point. I take it from Allan that the scalping, volatility scalping, it's a good way to think about it.
Yeah, you're right. And from my standpoint as a market maker, market makers are trading volatility basically the way you would trade a stock price. So what they're actually trying to scalp is the bid-ask spread, which is in essence is volatility scalping. And gamma scalping is done just to kind of manage the actual volatility position. But yeah, most option traders are volatility traders, and from a standpoint, most market makers are kind of naturally end up long vol, and most investors are naturally short vol, and that's the way it is. Here's question 2 is from Jim Thompson. It says, first off, Jared has been an excellent addition to the team and great show, Mark. I assume he's talking about me and not Mark Longo, because there's really only one Mark people care about. But I would agree you have been an excellent addition to the show. What does the Volatility Planet think of Flash Boys? Oh, particularly as it pertains to volatility. Are these the same players active in derivatives, and if so, are they causing or exacerbating volatility? That's a little different take on what we just talked about. Yeah.
And I would say too, I would point Jim to, I think we also talked about this a couple episodes ago, and I'll kind of play Longo's role here. There's a new podcast on the network talking about trading technology, and I've listened to a few episodes myself so far, and I gotta say it's really good. There was an episode with Blair Hull on recently that really stuck in my mind. If you are interested in these issues at all, I'm saying this, I don't get anything from this, but just on behalf of Mark Longo, that new show I think is really enjoyable and worth your attention on trading technology in the markets, and is going to go into these kind of issues in a lot more depth. So definitely check that out.
Okay. Well, yeah, I mean, I agree. And, it's interesting. What I do think for sure is that high frequency trading and some of this flash stuff widens markets, and it thins out markets. And, as I had said, that does exacerbate volatility. So those are the only two big listener emails we got today. And with that, why don't we, let's talk about our volatility crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, Jared, this is our crystal ball. Why don't you tell me about what you think is coming in the near future?
Like I said at the top, I haven't been this indifferent in a while. I was happy to sell gamma in the indexes earlier this year, and that's been working fine. But I've kind of a little bit pulled back just a little bit from those earlier commitments for the last couple of quarters. And by the same token, the VIX term structure had some interesting moves in the first part of the year, getting kind of flat at one point recently, and now it's fairly steep compared to the last several years of history anyway. So it's not like there's a really, really obvious trade to make on that end of things. I still think there's some value in further out on the curve. So I've been talking about this here and there a lot this year, how if you're going to be selling vol, going out to the middle part of the VIX curve, or even just in the index options, has been a better value than trying to sell the front month or second month in a systematic way. And I think that's still going to be true. There was an interesting trade that went up this week in the VIX. I think it was the September calls. Well, they were really selling those VIX September upside calls pretty hard. So you're even seeing some pressure now further out in time. And I think that's probably going to continue, but it doesn't mean the trades don't work. As far as the other indexes, like I said earlier, it's been a little while now since the NASDAQ and the Russell have diverged from the S&P. So, trading that convergence, I think, still makes some sense. It's still something that I'm looking for. And frankly, I thought it would kind of come together sooner than it has.
Yeah. When I look, they've really, just for my crystal ball, they've really pummeled that front month and those near-term options. I think at this point for 12.9, for a VIX of 12.9, I would be willing to buy some S&P vol and maybe trade something else against it. I don't know that the vol's in the S&P is going to go a lot higher, but I don't think it's going a lot lower at this point. So that's kind of my standpoint. And with that, Jared, what is let's do the volatility plug. What's going on? What's up with everything at Kleinman and Condor options and everything?
Yeah, we've had a great year so far, both in the managed accounts and in the strategies that I talk about, and so really happy with that. The research work I've been doing has been getting a lot of attention, and so that's that volatility tracker. So that's all stuff is going really well, and this has been a nice situation with markets being a little bit calmer and the economy looking a little bit on sure footing to start looking at some bigger research projects. So that work is just continuing. What about you? What's going on with Option Pit? Has a new course, right? And
we got there's some new stuff at Option Pit. We got some coursework coming out, some new chat stuff. I've been busy at Swan where we're really digging into kind of some new products that I can't get too deep into yet. We're working on this reinsurance corp that looks like it's we're really it's doing pretty well, and it's been a lot of fun to be involved with that. So I was just in Durango all week, so I had a good time hanging out in Durango with the team at Swan Wealth Advisors. So that's been good. And we're Option Pit. Yeah, if you're looking to learn, there's no better place. So with that, I'm going to thank Jared for being such a great co-host and a color man, being the Steve Stone to my Harry Carey, the Phil Sims to my Jim Nance. And I want to thank all of you for listening to Volatility Views. We'll see you next week.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.